The deadline on the debt ceiling remains in flux, with Congress in a deadlock. I'm Lori Chortis for AM Best TV. Here to discuss what this could mean for the economy and for insurers is Ann Modica, AM Best Associate Director, Credit Rating Criteria Research and Analytics. Ann, can you please explain what the debt ceiling is?
Sure, just to give you a little bit of background, the debt ceiling limits how much money the government can borrow. And once that limit is reached, lawmakers must either raise or suspend the ceiling so the Treasury can issue more debt. And the last time this limit was suspended was in 2019 for 2 years. So this brings us to August of 2021. And since August of 2021, the Treasury has been unable to issue new debt on the bond markets to raise cash. So when the debt limit extension expired in August, the Treasury kind of moves money around to cover the shortfalls in cash flow. However, there's only so far they can go with this. And in the beginning of September, Treasury Secretary Janet Yellen started to ring the alarm bells, and she announced that these measures would run out in mid-October. So last week, the Congress decided to fund the government through the beginning of December to buy some time. But they do need a new agreement, and political gridlock is going to make any type of bipartisan agreement difficult, and this could lead to a variety of extremely negative consequences.
So, what are those consequences if the debt limit isn't raised?
So all the consequences are negative, and they aren't particularly good for a country that is still trying to find firmer ground after the COVID-19 shock. So it remains to be seen how the Treasury will operate if the debt limit is binding, given the unprecedented nature of the event. However, if a deal isn't reached in December, the Treasury will have to make some difficult decisions about which creditors it will pay. We're unsure what the Treasury will do given the unprecedented nature of this crisis, but they did have a contingency plan when they faced a similar situation in 2011. So under this contingency plan, there would be no default on Treasury securities, at least in the short term. The Treasury would continue to pay interest on these securities as they come due. So as securities mature, the Treasury would pay that principal by auctioning off new securities for the same amount. And by doing this, they wouldn't increase the overall amount of the debt, and this would keep the country from going into default. But the really bad thing is that the Treasury would delay payments for all other obligations, such as payments to Social Security beneficiaries, Medicare providers, and other various, contractors and agencies. And the fallout from such a situation is dependent upon how long the stalemate lasts in government. The very short-term effects largely depend on the expectations of financial markets, businesses, and consumers. However, even prior to the debt ceiling, uncertainty among these groups, they were already really jittery, right? Due to a variety of concerns with inflation, the ongoing COVID-19 uncertainty, and the slowdown in economic growth.
So, what impact would that have on insurance companies?
So insurance companies, like all the other businesses, they would be impacted on a variety of fronts. But again, let me say that this will largely be dependent on how long the disruption lasts. Initially, we would see increased volatility in markets. Consumer and business sentiment and confidence would take a hit, which would lead to lower investment as well as lower spending, which could translate into lower premium growth. The longer this goes on, the economy would take a hit due to the lack of spending by consumer and businesses. Additionally, there would be a growing concern regarding the possibility of a recession triggered by protracted cuts in federal spending. The market conditions that I mentioned before, they would only worsen, and concerns about a default would grow. Obviously the worst case scenario is that there would be a default on the treasuries, and this would lead to a severe disruption in the treasury security market, and this would spill over to other financial markets and would also affect the cost and availability of credit. It would also undermine the reputation of the market as the safest and most liquid in the world. I don't think the default is, the base case scenario. Hopefully they'll be able to come to agreement, especially given the extensive ramifications that I went through. But I do want to note that treasuries don't have to go into a default to get a downgrade on the U.S. sovereign rating. In 2011, S&P did downgrade the U.S. and stripped it of its AAA credit rating for the first time after the treasury came within days of being unable to pay certain benefits.
Anne, thanks so much for speaking with us today.
Thanks, Lori.
That was Anne Modica, AM Best Associate Director, Credit Rating, Criteria Research, and Analytics. For AM Best TV, I'm Lori Chortis.